Welcome to the Daily Update. This is being prepared Monday, March 14th, where we'll look at the action in the market today and then see how things look for Tuesday, March 15th. It was a pretty negative day. We did see an attempt at a bounce earlier in the day. The futures were doing okay. We ended up having pretty much a flat open, and there was some initial buying, and it looked like this extreme pessimism that we are seeing and are still seeing right now. It looked like maybe that would provide some kind of a base. Plus, we have a few things in the background that are still positive, but the technicals are negative. And as the day went on, things turned more negative. And instead of gaining any ground, we just kind of went back down more to where we've been before. So we continue to be in that short-term range right now. This is going to be a big week. The Fed starts their meeting on Tuesday, but then they also meet on Wednesday, and then anywhere from 2 to 2:15 p.m., they will come out with their announcement. And the overall probability, in fact, the overwhelming probability is that they will raise interest rates 1/4% to 0.5%. And I'll show you how that looks on the chart. So expect the markets to gyrate after that. This is the first time interest rates have been raised since they were lowered to zero at the beginning of the whole COVID problem. And even though it's not a surprise, it's not a secret, really the Fed is supposed to do what the market is already telling it to do. There'll still be some initial reaction to this, and prices may gyrate and get a little bit crazy. For those of you that have taken my course that I post online, I go back to 2015, where we raised interest rates for the first time since the whole financial crisis, and everybody knew it was coming. It was not a surprise at all, but prices still gyrated that day that it was announced, and then the next day as well. Because it wasn't that long ago that interest rates were higher, we might not get that big of a reaction, but for some reason, the market will still react. And it's kind of an interesting thing to watch. What I'm planning on doing is recording as that happens, and I'll probably use a 1-minute chart. I'll go down to as low as I can, and I'll record that. And if it's interesting, I'll make that recording available. If it doesn't turn out to be that big of an event, I'll just not post the video at all. I just find that very fascinating to watch and to see how the market reacts to things, even when they know they're going to happen. So what can we take out of Monday's session? We had a flat open all the way from Friday to Monday. There's a lot of geopolitical things happening, but the market didn't gap either up to the upside or to the downside. We did see some initial buying up to Friday's pivot. Sometimes these pivot points from previous sessions can come into play. They can provide support or resistance. Well, on Monday, this one provided resistance. We went just about to that point, and then that's when the selling started. As the day went on, we saw pretty much the same sustained selling, and we went down to last Tuesday's low. We didn't quite get there. We were within breathing distance. And that's where the market ended up settling, is right near that low point. So we ended up being down 0.74% for the day. A little bit of an encouraging factor could be that on a down day, we saw average volume, where last week we were seeing very, very high volume. On Monday, on a down day, when volume tapers off, that is generally more positive. Plus, you have a lot of people that are just waiting to see what's going to happen. We have a big big economic report coming out on Tuesday, the PPI, Producer Price Index. That may really feed into the inflation fears. And then, of course, the Fed on Wednesday will be coming out with their announcement. So we're still looking at the technicals, and they're pretty much negative across the board, but we continue to be range bound. We're getting near the end of earnings season. Inflation is what everybody's talking about now, and it's going on not only throughout the media and who's to blame and why is this happening and so forth. Well, you're also going through this in your daily life as well. You're seeing prices really increase, whether you fill your car, whether you buy food, whether you pretty much anything you do is seeing prices really climb right now. And of course, we have the geopolitical concerns, mainly with Russia and Ukraine, and that is an ongoing situation. So what are some comments that we can make? They're not really that different from Friday's video. The S&P is still in correction territory. We're down 13% from the all-time high. The technicals are negative, but on the other end, we're showing extreme fear, which that can usually mean on a contrary basis that we might see some kind of a bounce out of this. It looked like it might be starting to happen on Monday, but then it fell apart. And this could take some time to play out. That's why at the very bottom, when I say possible base forming, we're probably not going to see a V shape. We haven't done any V shaping other than maybe intraday for quite a while now. We V shaped up out of the COVID bounce. And then anytime we saw weakness through 2020, 2021, we would see a V shape up out of that. Well, for the last lengthy time, intermediate period now, we have been going sideways. We are in a range. So to think that we're just going to magically bounce up out of that, of course, it always could happen, but it's not very likely based on what I'm seeing right here. So prices do remain in that range. We're still dealing with Russia, Ukraine, and that continues to go on and on and on. We have oil issues that are in the media, and oil really spiked up to over $130 last week. It fell back on Friday. It also fell back a bit on Monday. Inflation is what people are talking about. And then, of course, interest rates. We didn't have any economic reports that came out on Monday, but we do have the PPI on Tuesday. The market continues to be overvalued. The trend is negative with our ADX showing that we are getting stronger in the trend, and that trend is negative because we had the down day, because we've been down for the last few days. Both the bias and the momentum continue to be negative. So let's go back, look at the day's session, see what we can get from that, and then see where things look to be going moving forward from here. First, sentiment. We actually saw a little tick up. We were at 15 on Friday. Well, we went up a little bit to 16, but anytime we're under 20, that's the important part. And looking at the longer term chart, we're down here. And see other times before where we were able to bounce up off of these levels, well, we could stay down here for a while. We stayed below 20 during the COVID plunge for quite a while, but then ended up shooting up out of that. We'll just have to see if we're going to get some kind of a move that takes us back above 20. But so far that has not happened. And based on my personal analysis, it's probably not going to happen over the next few days. If anything, it may develop after the Fed makes their announcement on Wednesday. Looking at the VIX on a closing basis for Monday, we did see a tick up, and we've broken a little bit for the last few days. This period of higher highs and higher lows, we're seeing fear kind of start to go down a little bit. But on Monday with the down day, we did see the VIX climb overall, and it closed right about at the high for the session. The VIX of the VIX kind of chopping sideways a little bit. It increased a little bit on a closing basis, and it started to fall off at the beginning of the session, but as prices declined throughout the day, fear started to go up, and we closed right near the high. The Ulcer index is also going up a little bit. That just means that there's a bit more increase in fear in the markets right now. And then here's just the longer term chart to give you some perspective. Our different sectors, we had a down day. The energy sector, which has been doing very well, you could probably say this is profit taking. When you see parabolic climbs and people are seeing some really nice profits, they probably want to lock those in, and so they will sell, and that led to some weakness in the energy sector. You had about half and half of the sectors that were down. The financial sector actually had the best day. It was up 1.26%. Then here's looking overall. Energy, even with its down day on Monday, is still outperforming everything else by a long shot. And then way over here, you have discretionary, which is doing the worst right now. As far as our inflation, the BDI did tick up. It's still showing that inflation is coming into the picture. The CRB saw a decline. We were down 2.25%, but we've been just screaming higher lately. Well, it's not necessarily a surprise to see a bit of a pullback, and that's what we saw on Monday. But the overall trend is up and it's still intact. Then just to show you some of these things that I usually don't talk about, but they're making news, it's influencing inflation. So for a while anyway, I'm going to be looking at different markets. Wheat, where it really spiked up, well, it came back down. It's still very high, but we want to get some historical perspective. When wheat really spiked higher, that was back in 2008, and bad things happened then. So we also spiked back in the mid 90s, and then we saw some rough periods in the market after that. It really didn't have much of an influence with the .com boom and bust. The one that I'm really focusing on is looking at what happened in 2008 to what is happening now. We can see the same thing with oil. I'm sorry, heating oil, where it really spiked up, but then has since fallen back. When that happened last time, when we got to these levels, this was right before and then during the financial meltdown. I'm not predicting a financial meltdown, but the charts are telling us when these things have happened before, we tend to go into difficult economic times. And then nickel, which has also been making the news, it also spiked up in later 2007, and it spiked up last week, and it's still more at that same level right before things turned bad. There's a lot of differences between 2008 and right now, but we're also seeing a lot of similarities. And so I want to point those things out. Gas also spiked up. The last time it really spiked up to where we're at now was in 2008. Well, we've dropped back down from there, but we still hit that very high level. The aluminum index, another thing, back, and this doesn't go back quite as far, but this really spiked up back into 2008. Then we saw a lower high before prices really went low. Aluminum spiked up last week. Well, it has since dropped back. As far as the Fed watch, and the charts look a little bit different right now. They have a 98.3% chance that the Fed will raise rates 1/4 to 0.5%. And the 0 to 1/4, that's now gone again. And you have 1.7% of folks out there thinking that we might get 0.5 to 0.75%. But the overwhelming odds are that they're going to raise it 1/4 to 0.5% on Wednesday. And then they've kind of cleaned up the chart a little bit by taking some of those other things off. This just gives you some historical perspective coming up to the present day. We're also keeping an eye on the Fed balance sheet, because raising interest rates is to slow down inflation. Well, when the Fed balance sheet continues to increase, that is to help stimulate the economy by maybe allowing for inflation. So as I've said in previous videos, it's like the Fed is in a situation right now where they have their foot on the brake and their foot on the gas at the same time. Our technical alerts were mostly negative with the down day. The S&P had the 5,200, the death cross. It happened there, and you'll see that in the charts. And in some of the charts that I have, that's already happened. But that's pretty negative. And there are millions of investors who use this signal. I have a video on YouTube, a trading system called SMAC, the Simple Moving Average Crossover System. Now you can use the exponential moving average if you want to. I just use the simple moving average. That is a trading system, and there are a lot of people that use that. They go long when this cross is positive. They probably go they likely don't go short because most investors don't do that. They probably go from being in an S&P 500 mutual fund to going into cash. Well, with this crossover, a lot of that is starting to happen. At first, the Dow was able to get above 33,000, but then the Nasdaq went below 12.8. Before that, it got above 12.9, then it was down to 12.7, 12.6. The communication sector, which has been seeing some real weakness, it had a BPI cross below 30. That means we're getting extreme negative, where energy now crosses below 80. That is an official overbought signal. Things have been rising so far so fast. We're seeing a bit of a pullback, and now it's coming off of an overbought reading. Tech had a bullish BPI, but it crossed below 20. So, and I actually said that wrong. It should be a bullish percent index, and it's red. That's even more negative. The communications, they drop below 30. Well, the BPI for the tech sector has dropped below 20 now. So that's even further into oversold territory. Oil, with the down day on Friday, and then on Monday, it had a MACD crossover, and it went below 105. Some of these are important, some of them are not. I mean, why is 105 important? Because it's a round number that is easy to report on, and it gives us reference points that we can look at. Intraday, way over on the right, we didn't see much of a gap from Friday's close to Monday's open, but we saw some initial strength right here. And we were actually trying to get above some previous resistance. Well, we got right up to this point, which this is the pivot for Friday, and that acted as overhead resistance. From that point on, we saw sustained selling. We tried to take a stand a little bit at the unchanged level, which again, because we're coming down, that could have been potential support. That has worked in the past, but it didn't work on Monday. We then saw selling continue, and we dropped all the way down to S1. We kind of stayed below S1 for most of the session. And then you see this other dark line here. This draws back to last Tuesday's low. We didn't get quite down to that level. We're just a little bit above that right now, but it is currently acting as a support level. Then here's on the daily chart. You can see where Monday's low was a little bit higher than last Tuesday's low, but we're seeing a more negative environment right now, but we're not really breaking down yet. We still have the S1 below where we're at. We have fallen through intermediate term support, but then we have longer term support still below where we're at currently. We're down 13% right now from the all-time high. Growth saw a decline, value saw an increase when you compare the two areas with each other. And then here's the indexes, which is showing growth declining in comparison to value. And then here's value increasing when compared to growth. Nasdaq 100 really underperformed the S&P 500 on Monday. As far as our trend, we're seeing the ADX continuing to climb. It's above the moving average. Even though the selling line, this red line, has been declining, we saw a bit of an up move on Monday, and we're seeing buying power really taper off. Because the red line is on top, that means that the trend is negative. Mass index, we're just kind of waiting. turning up and may be getting ready to generate another signal, even though we really didn't get much out of the last signal that was generated. The Arun improved a little bit. We don't see selling pegged near the top. That means that its full-blown sellers are in control. It is declining, but so is buying. It is also declining. When you compare the two, it bumped up a little bit and is still negative overall because we are below zero. This is what we're keeping an eye on. We've had a cross with the Pring bottom fisher. This doesn't pick tops, it picks bottoms. And this sometimes is a good signal. We saw one back here, didn't really help us. We had a few good days after that, but not a real significant move. We're seeing another signal now, so we're just keeping an eye on that. Here is the death cross, where you see the 50 period moving average coming down to the 200 period moving average. No change in the decision point scorecard. As far as breadth, we had a down day, but not real significant. However, overall, based on price, we are declining. Based on volume, we're showing even more weakness, where this negative divergence is really coming more into play currently. AD ratio been bouncing around. This is a pretty sensitive indicator. Well, we've been just floundering now for the last number of days. It's negative because we're below zero, and it is pointing down because of the down day. We lost the one gem, or the positive thing, where new highs and new lows had been tapering off, but the trend was still going higher. Well, we have now crossed below, and our 10-day moving average is also turning down. Accumulation distribution, we're below the moving average with prices below that moving average and declining. And then looking at some short-term charts, we're well below the 20 period moving averages. When you study the 20, 50, and 200-day moving average, we are seeing declines overall. They're flattening out a bit. That's because we're bouncing around, but they are headed lower. We're well below all of our moving averages right now. And the moving averages, these look like streamers falling from the sky right now, or fireworks. The MACD is negative and going lower, and still could go lower before giving some kind of an extreme reading. The STO, which sometimes goes in opposition to what we see happening with price, it actually ticked up a little bit on Monday based on price and volume. The McClellan oscillator, it's still negative, but did tick up also. But since we're below zero, it's negative overall. The Stoke RSI has crossed below the 0.5, so now that's more negative. Williams percent R is declining and getting close to going into extreme negative territory. The force index also saw a decline on Monday. Intermediate term, we're well below any 50 period moving averages now. The PMO is heading lower. It looked like something might be happening with these other two indicators after Friday, but we're losing that now with the down day. Based on price and volume, the PMO is negative overall. We were pretty much flat on Monday with those PMOs that are rising. We're trailing off those that are giving buy signals, and we are declining with those PMOs in the S&P 500 that are even above zero right now. The BPI is kind of sideways, but still negative overall. And here's the longer term chart where we still have more room to fall. Moving average rainbow, we're well below the rainbow with more of it starting to come crashing down. Stochastics, negative short term, negative intermediate term, negative longer term. Summation index heading lower based on price and volume. The one oscillator that was looking okay after Friday was this top one, slope. Well, it's rolling over now, and all of the other oscillators are now headed lower. Vortex, we are seeing sellers in control because of the red line being on top, but it's starting to flatten out and get near a neutral reading. But we're not seeing a real pickup in buying power, at least yet. RSI continues to head lower and is below 50 and does have more room to fall before it gives an extreme negative reading. Then the rate of change based on 50 periods shows that we continue to be in extreme negative territory. The Sean trend meter also extreme negative and not turning up, at least yet. The CCI 14 periods is going back into extreme negative territory, as well as based on 20 periods. As far as our trading systems, the elder system is negative. And this is a change. The SIR finally switched over to a dot being above. This is negative. So where it tried to hang in there as long as it could, but after recalculating things on Monday, the dot is now above. Our different charts, the Heiken Ashi is showing more weakness. The Kegi is also showing weakness. The Renko continues to show weakness. 3-line break is actually redrawing itself a little bit and showing weakness. Equi-volume showing that we're getting near some significant support. And one day with the EASA movement, that's negative because we had a down day where it's flat to slightly advancing. If you calculate this going back 14 periods, this tries to measure the path of least resistance. There's no change on the point and figure chart. We had some new circles drawn in after Friday. Well, now they just turned to black circles, but no signal within this is being generated right now. We're getting down more to the 61.8% retracement from the all-time high, going back to the significant low that I'm using as longer term support right now. So we're just continuing to bounce around. Long term, the arithmetic scale, this is looking more and more negative. We're just camping out under the 200-day moving average longer and longer and longer, where here's the logarithmic chart as well. Then here's a new chart. These are the mega caps. These are the monster stocks, the Amazon, the Google, the Apple, the really, really big stocks. Well, there's an ETF based on that. And I'm going to start including that just to show how the real big boys are doing. Because those of you that watch these videos and also trade individual stocks, whether you do option strategies or something of the like, you want to be involved in stocks that have a lot of volume. Well, the big boys, they do have a lot of volume. So it's in our benefit to keep an eye on these. Well, we've been seeing a lot of strength. A lot of weakness. A lot of the strength that we saw from 2020 through 2021 came from these stocks. Well, as we're trying to decide, are we going to get into more value things? Are we going to get out of tech and the real big monster stocks? We're seeing these really decline overall. The special K continues to trend lower, and we get a longer term perspective of the K, the special K. We're still seeing a series of lower highs when you look at the 50 period moving average, 150 period moving average, and the 200 period moving average. There's some real technical damage that we're starting to see, but these can act like oscillators. So once we get down to a really extreme negative level, this can provide some kind of a base for prices to go higher. But right now, it doesn't look like that is happening. And then this is a new one that I haven't shown for quite a while. This is the rate of change going back 200 days. There's roughly 200 days in the trading year. I know there's more than that, but a lot of people base things on this. And as we were really screaming up, we were getting way out of line for where we historically go. Well, the reason I bring this up is with the declines, for the first time since 2020, we're actually getting down to where this rate of change measurement is giving us a negative reading. We've been declining, but the numbers were positive. Now we're starting to see a minus sign. in front of these numbers. As far as some broad market things to look at, here's the S&P. We're kind of just back down to where we were last week. Mid caps also showing some weakness, but still within this overall range. The small caps, which have been holding up a little better and may provide some kind of support that I pointed out in the video for Monday. They had a down day, but overall they've been holding up okay, even though we saw that weaken on Monday. The FANG stocks had a down day, down 3.88%. ARK also had a bad day, down 5.92%. The Dow, kind of back to where we are. We've been chopping around in the same range for a number of days now after having had a death cross. Small caps, this is what I'm talking about, where they're more range bound, and they were down over 1% on Monday, but they seem to be holding up a little better currently. Mid caps also holding up okay, but still within the range. We're still above S1, but we've dropped below the pivot. Nasdaq looking more weak. We've dropped below S1. That had provided some kind of support in the past. Well, we closed below S1 on Monday. Nasdaq 100, same thing, dropping below a support level. Then looking at the Vixen, with the down day with the Nasdaq 100, we saw fear increase, but not necessarily to an extreme level. With this chart, we still do see a series of higher highs and higher lows, and we could spike higher. We're not seeing any kind of blow off fear yet. This is more sustained fear over a longer period of time that keeps growing and growing. Nasdaq 100, I'm sorry, the NYSE is now down to the bottom of this range after having dropped out of the other range, but it's still above S1. S&P 100 did underperform the S&P 500 on Monday. Wilshire looking similar to the NYSE. We want to see, are we going to be able to hold this S1 level if prices continue to fall? Internationally, China's just being taken out and shot right now as far as their stock market is concerned. They're in a real downturn, but all of the international markets overall are in decline phase right now. And then our international stocks, they bounced a little bit on Friday. Well, we saw some more weakness on Monday after having seen a death cross. For some other broad market things to look at, the dollar, it pulled back a bit on Monday. It's just been going really higher. So it dropped below 99. Then here's the new weekly chart. For the week, it's really been showing some recent strength. So it's not surprising that we're seeing a bit of a pullback right now. Oil, yes, we spiked up over 130, but now we've dropped back down. We're still at 103, which is very high, but well off of where we were before. And then this is just another look at the continuous futures contract as well. Gold, after having looked like it was really shooting to the moon, has been pulling back recently and was down 1.5%, at least as far as the ETF is concerned. And here's just a longer term look, just to give you some ideas of where we topped out before. Silver also, after looking like it was gonna break out, is now falling back. And then here's a longer term look at that same chart. Palladium also spiking and then falling back. Bitcoin it spent a lot of last week in the low to mid 40s. Well, it's now down in the upper 30s because they're not really sure what's happening with all the different things that are going on concerning cryptocurrencies. So I follow this all the time on a 10-minute bar chart, and it's like somebody when their heart stopped. I mean, it's just going sideways with little blips up and little blips down from time to time. Bonds, we're still seeing this yield curve coming down. Even though it bounced a little bit on Monday, it's still coming down overall. And even if we fall down here, that does not mean a recession will happen. But anytime there has been a recession, this has happened. So sometimes this can give some false signals. So we want to keep a real eye on this. We have broken above resistance and are now heading back up to the 61.8 level as far as the yield on the 10-year. We're up in the 2.14% range now. And we did see a real spike in yields, the 30, 10, and you're starting to see the 10 and the 5 get kind of close to each other now. Okay, and then the 2-year spiked up, and we also saw an increase in the 3-month. Internationally, we are also seeing an overall increase in interest rates. As we see that increase in interest rates, we are seeing a continuation of declining prices in the price of bonds. Corporate bonds also got hit pretty hard on Monday with the most recent yield that I could find. It's a little outdated. This goes back to March 11th, which was last Thursday. Or was that Friday? Yeah, that was Friday. We're starting to see yields pop up a little bit. Okay, I think I had the same chart there twice for some reason. And then junk bonds, they tend to perform better when the stock market is performing better. Well, as the S&P and other indexes have been going down, junk bonds have been going down too. Our relative studies, looking at gold versus the S&P, it's still breaking out, but has fallen back. Energy versus the S&P. With the decline on Monday in the energy sector, it's pulling back, but we're still seeing a breakout overall. The growth versus the 20-year bond is also showing that growth stocks are really underperforming longer-term bond prices right now, even though bonds aren't anything really wonderful right now. But a lot of people see that as a flight to safety. They would rather be in something where they're going to lose less instead of being in a tech environment where they could lose a lot more. And then looking at tech versus the S&P, tech continues to underperform. And then looking at tech versus the 10-year yield. As yields go up, tech prices are really going down. And then looking at the 10-year, this is just a flip-flop. This is just showing how the yield on the 10-year is really outperforming tech currently. And then we also look at discretionary versus staples. Well, discretionary is really falling off as people are getting more into the value areas of staples. And then comparing the S&P with the 10-year yield, where the S&P is really underperforming the rise in interest rates right now. And then this is the small cap study that I'm trying to get something from right now, where we're seeing this red line is the IWM. That's the Russell 2000 ETF. Even with the decline on Monday, we're seeing it bounce a little bit as the S&P goes down. And if you look back in the past, there have been times when small caps turning up has then seen the S&P turn up after that. But there are some false signals in here too. So this is just something we want to watch. So what are we looking for Tuesday? The S&P's in correction territory. We're in that intermediate term range, but we're getting really near the bottom of it. We're getting near the end of earnings season. We're still battling between growth and value. The big report is the PPI on Tuesday. And then, of course, the geopolitical events are Russia, Ukraine, and then the FOMC meeting, which starts on Tuesday, and then we'll have their announcement on Wednesday. So we are negative and at the bottom of the range. Short and intermediate term, the bias is negative. The long-term bias is turning more negative day by day. but I'm still kind of playing with that scenario because of extreme pessimism. And with the small caps and some of the other things that we're seeing, is there some kind of a base forming that we might be able to see a launch from? We're not seeing that yet, and the base is still continuing to form, and it may end up being a false signal, but we still want to keep an eye on that anyway. So thank you. I hope you have a wonderful Monday. I'm sorry, a wonderful Tuesday. And I will talk to you again after Tuesday's session.